EPK Capital presents Daily Brief for 23rd October 2025. Hello, and welcome to EPK Capital's Daily Market Briefing. I am your host, Rutvik, bringing you the most critical financial news and analysis from the last 24 hours. In the next few minutes, we will unpack a turbulent day across global markets. The big story? Tesla. The high-flying automaker's stock took a significant hit after last night's earnings miss, dragging the tech sector down with it. Meanwhile, the macro environment is getting complicated. The ongoing US government shutdown is now the primary focus, creating uncertainty and even delaying key economic data. We also had a crucial update on the US housing market and heard from Federal Reserve officials. And in the crypto world, digital assets face pressure as investors moved away from risk. Let's get right into the numbers. The closing bell, index levels. Starting with the closing bell in the United States, it was a decidedly negative day. The optimism we saw earlier in the week has faded, replaced by concerns over earnings and political gridlock. The S&P 500 closed down 1.2%, or 80 points, finishing the session at approximately 6,619. The tech-heavy NASDAQ composite was the biggest loser, pulled down by its largest components. It fell 1.8%, or 410 points, to close around 22,330. The Dow Jones Industrial Average held up slightly better, but still finished in the red, shedding 0.7%, or 328 points, to end the day at 46,262. This risk-off sentiment was a global story. Earlier in Asia, markets were mixed as they digested the Tesla news and regional concerns. Japan's Nikkei 225 managed to eke out a small gain, rising 0.2%. However, Hong Kong's Hang Seng Index fell sharply, dropping 1.6% as tech stocks there followed their US counterparts lower. Mainland Chinese and South Korean markets were closed for a public holiday. In Europe, the session was choppy but ultimately negative. The FTSE 100 in London slipped 0.3%. Germany's DAX fell 0.5%. And the CAC 40 in Paris ended the day down 0.4%. So, what drove this widespread sell-off? It was a 1-2 punch of macro fears and a major corporate disappointment. Macro movers, shutdown and housing slump. The biggest story on the macro front is the one that's not getting solved: the US government shutdown. We are now deep into the shutdown, and the economic consequences are starting to bite. Today, this had a direct impact on the market's data flow. We were scheduled to get the weekly initial jobless claims report this morning, a key indicator of labor market health. However, the Department of Labor did not release the data due to the federal funding lapse. This lack of visibility is making investors nervous. The consensus expectation was for a slight rise in claims to 223,000, but we are now flying blind on one of the Fed's most watched data points. We did get one major piece of data from the private sector. The National Association of Realtors released its existing home sales report for September. The numbers were not good. Sales of previously owned homes fell to a seasonally adjusted annual rate of 3.95 million units. This was a miss from the 4.06 million forecast and a clear sign that high mortgage rates continue to cripple the housing market. This is the weakest reading we've seen in over a year, and it confirms that this critical sector of the economy is in a deep recession. The market reaction was swift. Bond yields ticked lower on the news, with the 10-year Treasury yield falling as investors priced in a slowing economy. This data confirms the Federal Reserve's policy is working, perhaps too well. Political and Fed commentary. With the shutdown as the backdrop, all eyes were on Washington. We heard from two key Federal Reserve officials today, Governor Michelle Bowman and Vice Chair for Supervision, Michael Barr. Governor Bowman, who has recently been one of the more dovish voices at the Fed, reiterated her concerns. While her prepared remarks focused on banking regulation, she noted in a Q&A session that a prolonged government shutdown introduces significant and unnecessary uncertainty into the economic outlook. She repeated her view that the Fed must be highly data dependent, which becomes difficult when the government isn't producing that data. Vice Chair Barr spoke at a financial stability conference. His main topic was bank capital requirements, but he too was asked about the shutdown. Barr's main concern is financial plumbing, stating that while the system is resilient, a protracted shutdown could begin to stress short-term funding markets. Neither speaker gave a clear signal on the next interest rate move, but the combined tone was one of caution. The message is clear. The Fed is watching the shutdown's economic fallout just as closely as the market is. On the political front, there was no progress on a funding deal. We heard familiar comments from both the White House and congressional leadership, with each side blaming the other for the impasse. This gridlock is the primary source of market anxiety today, as it raises the risk of a more severe economic slowdown. The big story, Tesla's tumble. Now for the biggest corporate story of the day. After the bell last night, Tesla reported its Q3 earnings, and the market was not impressed. While revenues of $28.1 billion just beat expectations, the company missed on profitability. Adjusted earnings per share came in at 50 cents, well below the 54-cent consensus estimate. Investors were focused on shrinking profit margins, which were hit by the company's aggressive price cuts. During the main trading session today, investors and analysts rendered their verdict. Tesla stock was under heavy selling pressure from the opening bell. The stock closed the day down 9.2%, wiping out tens of billions of dollars in market value and acting as a massive anchor on the entire NASDAQ 100 and S&P 500. This earnings miss has analysts questioning the growth at all costs strategy and its impact on the bottom line, especially as competition in the EV space heats up. Tesla wasn't the only earnings story. We are in the thick of earnings season, and investors were anxiously awaiting results from several other bellwethers due after the close today. Shares of Ford and Intel were both slightly lower during the session as traders were hesitant to take on new positions ahead of their Q3 reports. Blackstone, the private equity giant, also reported before the bell. The firm's distributable earnings beat estimates, driven by strong performance in its credit and insurance division. However, the stock gave up early gains to close down about 1%, weighed down by the broader negative market sentiment. Crypto in the red. Finally, let's look at the cryptocurrency market. It was a classic risk-off day, and crypto assets felt the pain. With investors fleeing to safety amid the Tesla sell-off and shutdown fears, volatile assets like Bitcoin and Ethereum were sold. Bitcoin is currently trading down about 3.5% over the last 24 hours, falling back below the $105,000 level. Ethereum is seeing similar losses, down around 4%, and is struggling to hold $3,700. There was no major crypto-specific news driving this. This was purely a beta move, with digital assets trading in lockstep with the NASDAQ. The macro environment of uncertainty and a flight from growth stocks is creating a difficult headwind for the crypto space in the short term. The final word. So, to recap the day, a major earnings miss from Tesla sparked a tech-led sell-off. The US government shutdown is now actively disrupting economic data, adding a new layer of uncertainty. A very weak existing home sales report confirms the housing market is in a deep freeze. And crypto assets fell as investors dumped risk. Looking ahead to tomorrow, the market will be digesting the after-hours earnings reports from Ford and Intel. But the dominant story will remain the political gridlock in Washington. Until we see a clear path to reopening the government, expect volatility to remain high. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.